Well, good morning, John. It's good to see you again. We had some good news from the Olympics overnight. Australia secured another four medals to take our tally up to 18, which is the best ever. Isn't that fantastic?
Well, I think you're going to say later, Paul, that there's no gold medal for the Reserve Bank or the Federal Treasurer. So someone's got to be winning gold medals if they can't do so in Canberra. So it is good news, great for Australia. And if you look at per capita, which is what I always look at as an economist, it's fantastic in terms of the per capita ratio of medals, gold or whatever, to population. We're way above our weight. And I wish we'd do that more in other parts of the economy, but we'll talk about that shortly.
Yeah, it's quite incredible that we're ahead of France at the moment, which is the home country, which you'd expect them to have asserted their dominance by now.
Yeah, but Paul, it's a good point. We're well ahead of France and Germany and Italy. Like they're big population centres, but does it indicate that they're ageing populations? And so the per capita to youth, the ratio of sportsmen to youth is declining. I don't know, but it's interesting observations that Australia, which has a younger population, is doing better.
Yeah. John, so much to talk about in the last week. I've thought about how to structure this conversation. I thought what we'd start off with is the question, what has actually happened to markets? Secondly, would be the question of what were the catalysts for what happened? The third question is, what are the implications? And perhaps the fourth, what should individual investors do and how should they respond? But let's in order. Let's start off with what's actually happened. So up until the end of July, markets were in fairly normal, trading in fairly normal patterns. In fact, it was quite remarkable that for a year before, we hadn't seen a 2% or more a decline in the steady increase in markets. Then August occurred, and since then, what's happened to markets? Tell us.
Well, I think there's a few red lights flashing. Obviously, it's easy to see in the rear vision window when you go past them, but we did talk at least a week ago, maybe a week before, about Commonwealth Bank and the share price and the valuation. The price to valuation was at historic highs, and that was symptomatic, I think, of a lot of stocks, large stocks around the world. We had our own Commonwealth Bank, but they had other stocks in America and Europe. Valuations were extended, and particularly against the fact that bonds were trading, American bonds were trading 4.25%, 4.3%, and well above, or reasonably above inflation, so you had real yields. So the valuation arguments weren't there. And what happens is, the markets will run and run and run, and then there's a catalyst. What was the catalyst? A weak employment number in America. Everyone jumped on that. It's a 1 month number. It's not a trend line. So I think the market was looking for a reason to correct, and it got it. And then we had we talked again last week, Paul, about Japan beginning to move interest rates a long way from normal. But there's been a lot of borrowing in Japanese capital markets and dispersing that capital around the world. And so what we had is an interest rate increase in Japan, a revaluation of the yen, and those groups, and there may be a lot of hedge funds, I don't know, borrowed in Japan cheaply, didn't see the Japanese yen as a risk, all of a sudden had to wind up these trades. So you've had a couple of events occurring at once, and down she goes. And as you said, we haven't had a decent correction for a while. There used to be, you remember, Paul, we used to talk about healthy corrections. They're healthy if you don't need to sell, very unhealthy if you leave it into that sort of market. So we've had what I'd call a healthy correction and pause for fault.
So let's just drill into a couple of those factors a little closer. So in Japan, what happened was that the Bank of Japan, the central bank, increased interest rates essentially from 0 up to 0.25%. Not a huge increase, but as you've explained, it consequently meant that the Japanese yen surged something like 10%, which for one of the world's major currencies is a huge move. And that disrupted what is called the yen carry trade, where people borrow in yen, invest elsewhere, and all of a sudden everyone was scrambling for the exit door, and Japanese stock prices fell 12% in a day. This is the second biggest capital market in the world, and a very large trading partner for Australia as well. Over a 3-day period, the Japanese market lost more than it had, something like 20%. John, you and I remember, the crash of 1987, and we have to go back to those sorts of times to see a fall commensurate with that period. But the other catalyst in the US was this very weak employment number, which all of a sudden had people questioning the soft landing scenario. All of a sudden they were talking about the possibility of the US going into recession. So if we talk about those two catalysts, firstly, what's happened in Japan, secondly, what's happened in the US, do you think that conditions have materially changed in those two jurisdictions, or is it just a case of people scrambling for the exit door all of a sudden at the same time and trying to get ahead of the pack?
Look, the traders have to exit quickly, and I think people watching this video have to understand there's a lot of liquidity in the world market, and there's a lot of leverage. And hedge funds use a lot of leverage. They might have $1 of capital at risk for $2 and $3 of debt. And when they get debt made available to them at very low rates in a foreign market like Japan, and for whatever reason, after years of not worrying, they don't hedge, and then all of a sudden you get a very sudden correction like we saw. But it worked out pretty quick. It was down over a couple of days, and then I think one day it rallied 8%. So very much, yes, the down was like 87, but the recovery wasn't like 87 at all. It was a very quick recovery. So the Japanese central bank has come out today and said they're going to be a lot more cautious about putting up interest rates, as you would expect. So that's stabilised that. The other issue is, as the yen rises, guess what? They don't have an inflation issue on imports. And then all of a sudden people go, oh, the inflation, which has been sitting at 3% in Japan, all of a sudden they're projecting it's going to go back towards 2% in a real hurry because of the yen strength. So that's the good side of it, which also means that interest rates in Japan don't need to go up that much against inflation. So it's an interesting observation about what happens when you stretch valuations excessively. And I'm talking about bond prices excessively in Japan. In terms of America, yes, it's 1 month. If you look at the trend lines, it's a low growth in employment month, and participation went up, or potential participation went up, so you had an unemployment surge above 4%. And then all the scribes got out some ratio they looked at over the years and said that this is precursor to a recession. Now, these same people have been calling recession for 3 or 4 years, so they've got to get it right one day. But I maintain that if there is a recession in America, it'll be very mild. And I think we're in a period now where America's economy grows at a fairly mild rate unless it gets a massive stimulation program. Now, it's already getting stimulated through the fiscal massive fiscal deficit. Does a change in administration, a new president, particularly a Trump, does he really push the American economy by bringing back manufacturing or stimulating manufacturing coming back to America? And that would turn all these ratios around pretty quickly if that occurred. I'm not too sure what the Democrat presidential elect is suggesting. It's not clear. A lot of nice words, but not much policy as yet, so we don't quite know. But both parties are going to have to deal with a massive deficit, fiscal deficit, as they take over in 2025.
Yeah, so there were a number of catalysts to the sell-off. The first one, as you've articulated, were very highly stretched valuations. The second one was the Bank of Japan raising rates. The third one was the employment number in the US increasing the odds of a serious slowdown. But there were a couple of other catalysts as well. namely that Warren Buffett made a big call. He reduced his holding in Apple by half, and Warren Buffett, you really do have to pay attention to him because his timing is extraordinary. And then, as you mentioned as well, the American presidential election, a reversal of the Trump trade. So the market has been very friendly towards the idea of Trump winning. And the betting odds were that, perhaps Trump was a 60-40% favorite, with Kamala Harris taking over Biden. Those odds reduced to kind of 52-48. So there was a reversal of the Trump trade. Quite a few different catalysts. And in terms of market movement, the NASDAQ has fallen around 10% from the peak. The S&P 500 about 8%. Our market only about 4 or 5%, depends how it opens today. So we're seemingly doing better than perhaps the American markets. But it's interesting that the narrative that had been driving markets for the last year was AI and the big tech companies. And that's where we've had the sell-off being greatest, which is not unexpected. Stocks like Nvidia had doubled over the last year. So to take off 25%, perhaps that's just sensible.
Exactly. There's an old saying, you go up by the stairs and you come down by the elevator. And that's true of markets. And go right back to your first commentary. We haven't had what is a normal correction in a rising market for 18 months. And so we were well overdue for a reassessment of value. You have to work out what are the trigger events for that assessment. But I think stabilisation will occur fairly quickly. There's no doubt that interest rates are going to be cut now in America. We've been consistent in our theme for well over 6 months, almost a year, saying American interest rates are too high. And now there's a chorus coming from economists and commentators saying, has the Federal Reserve moved too late? I think they have, but I'm not worried about a recession. I just think they've set interest rates 0.5%, half where they should have been for last year. Whether they do a 0.5% cut very quickly in September, I don't think they will, because that almost is a suggestion that they didn't manage it properly. Everyone knows they haven't done it, as they haven't done in Australia. And I think we should have a good look at what's going on in Australia in the last week with this debate about inflation and federal government expenditure in the budget, which I think is now getting off the rails quite somewhat, because I think the Reserve Bank, like the Federal Reserve, has not managed the monetary policy correctly. And now they're ducking and weaving and blaming everyone else. But if you look at history, the true culprit in all this is the central banks of the world. And Australia's central bank should not be let off lightly. Yeah,
it's interesting that one of the catalysts was, as you say, the rise in unemployment in the US going up to 4.3% after bottoming, 12 months ago at 3.4%, and that has triggered what people refer to as the Psalm rule, which is that if unemployment goes up by 0.5% above the 3-month moving average of the preceding 12 months, it means that the US is in recession. But patently, the US is not in a recession. You've got still strong or reasonable consumer spending in the US. Personal income, real personal income, is still rising. So it seems not credible that the US is on the precipice of recession. Although I do note that Goldman Sachs increased their probability of recession from 15% to 25%. It still means that the 75% probability is for a soft landing, which you seem to agree with. And obviously, the Federal Reserve has lots of room to move to cut interest rates, whether it's 50 basis points or 25. I agree with you, it's more likely to be 25, but that could be followed up with 2 or 3 consecutive cuts early next year, to take the pressure off. So chances of a hard landing still seem fairly remote to me.
Yeah, and we're not going to get a hard landing in Australia. As we've been saying for months now, Australia's not going to cut interest rates until America clearly cuts theirs. The die has been cast. US will start cutting in September. The RBA's pushed back in the last few days, saying, well, it doesn't mean we're going to cut this side of Christmas. Time will tell. At the same time, Paul, if you read the announcement from the RBA, they've upgraded Australia's growth in 2025, which is what we've been saying as well. I mean, I'm not saying we get everything right, but we made the comment that Australia's growth outlook in 25 was much better than was forecast by the RBA and indeed the government in their budget. Now, these sort of growth figures we're projecting, yeah, that may suggest that interest rates won't come down quickly in Australia. Maybe they shouldn't anyway, because I think they're appropriately pitched, given inflation and given the growth going on. But the upgrade to growth means that probably the most thing we're going to see is the budget outcome is not going to be as dire as suggested by the Treasury himself, forecasting a $24 billion deficit. There's a real problem in Australia between what Treasury says and what the RBA says and what politicians say and what commentators say. And I really want to make this point. I think that the last few days have shown that the RBA is talking twaddle. They manufactured a lot of the problems in Australia. The biggest inflation problem in Australia was the cost of housing. And I just sit here and watch. The RBA said nothing about the cost of housing. It has no idea what to do. It knows that mortgage rates are too high and people are too highly geared, and they allow that to happen. On the other side, the Australian government should be attacking inflation much more aggressively. The puerile electricity rebate should have been doubled or tripled. There are ways to give cost of living relief and then claim it back for those who don't need it through the taxation system. And it seems to be a lost art in this country. They're very quick to put on taxes and then give it back to you, but they should also give to you and take it back to you if you don't need it through the taxation regime. And, you know, we lost an opportunity. That there's too much indexation of government charges and toll roads and nonsense like that. Why are we indexing inflation into the system? So I just watch this debate, Paul. I know I'm cut across you here, but I just think Australia's got a real problem with. I won't make a comment on the Treasurer, but I think Treasury comes up with remarkable changes to superannuation taxes, but can't come up with remarkable anti-inflationary policies. And the RBA sits there claiming that inflation is all about the government policy and has nothing to do with the asset inflation which they've caused. And they cannot deny if the cost of housing goes up, it's going to feed through the cost of living and go into the CPI and then go into wage increases and then come back into the CPI. These guys don't seem to understand you need to break the nexus of inflation every way possible. And both the Reserve Bank and Treasury are derelict in their duty. And I want to make that very clear.
Yeah. So, John, when we opened the session, I said that we'd cover basically what has actually happened to markets, what were some of the catalysts, what are the implications of the fall, and then the fourth question is how should investors respond? Now, when I started out as a stockbroker back in 1986 and experienced the 87 crash, one of the first things I was taught by the wise old heads is don't jump on a moving train. It's very dangerous. How do you think investors should be responding? Because we are seeing a lot of daily volatility. It is dangerous. There could be corpses that float to the surface. We don't know which hedge funds have gone bust because of the unwinding of the yen carry trade or other casualties. So what should investors be doing? How should they be responding to this period of volatility?
Well, I know you've used the word investor, but hopefully I'm talking to investors. I'm not talking to traders. Traders will do whatever they have to do every day, every minute of the market, and they just ignore their nonsense. Investors reassess the market based on information as it comes in. Investors are generally trying to accumulate inside an asset class, or they're trying to move between asset classes based on information. And the biggest information you have is the risk-free rate of return, which is the bond yield, and the bond yield compared to the inflation rate. What we've had in the last week, Paul, is a substantial decrease in the risk-free rate of return without an increase in inflation or movement in inflation. So real rates have dropped substantially in America, going right out the yield curve with an expectation of interest rate cuts and a 10-year bond rally. Now, all things being equal, that's positive for the equity market. If we don't have a recession, the valuation argument for the equity market just went up. Now, whether the price of the equity market against its value is fair is a different issue. But I would have thought in the last few days that true investors would say, well, things have dropped 5 and 10%, in some places 20%. Crikey, it's got to be better value than it was a week ago. I'll put my buying hat back on, see what I want to accumulate. And where in these markets is the best value? Now, it's not, you don't have to be a genius to say, well, if the 10-year bond has rallied 0.25% in America and Australia, well, then if you were lucky enough to own long-dated bonds, which I don't, well, you'd take that money, take that profit and look for a redeployment somewhere else, and you'd be looking in corporate debt markets, you'd be looking in equity and property markets. So I appeal to people to stay invested. How you're invested is the issue, okay? Traders, don't listen to it. Don't read too much into short-term price moves. Yes, we can reflect as we are doing today. And yes, people say, well, why didn't you tell me 2 weeks ago that things were stretched? We did sort of indicate that when we looked at the Commonwealth Bank a few weeks ago, it was on record highs, and should have been, something to be aware of. It may well go back to record highs in the next few weeks. Who knows when it's come div. But my point is, we're here to invest. We're here to invest logically, and we're here to take a longer-term view and not panic on every spurious commentary that comes out of economists and hedge funds around the world, and then central banks who really have messed up the whole world, frankly, since the GFC. But that's probably another interview, Paul.
Yeah. It sounds like you're still pretty optimistic about prospects for the Australian economy in 2025, though, which...
Well, they just upgraded.
Yeah.
Oh, they just upgraded. I mean, here you had the Reserve Bank going on about how dire things are. If you read their diatribe, 1 minute they say the economy is growing too quickly, then they say the consumer's under stress, and then they upgrade their growth for 2025. And I challenge anyone to read what they say and make any sense about what they're saying. And that one of the treasurers got himself into a curdle because he couldn't make sense of it. Not that he makes a lot of sense anyway, but there's too much nonsense going on in economic forecasting by the RBA and the Treasury. They're not on the same page. I don't know why we don't have a centralised economic forecaster. Takes it away from these two groups who seem to be talking their own book. As I said earlier, the RBA is defending some absolutely ridiculous decisions it's made over the last decade. Letting the credit market get away from it, the housing credit market, too slow to put up interest rates, having too much credit flowing, then dropping interest rates to zero and panicking and filling the economy full of liquidity. Now, obviously, at the time, we were all panicking, but they went overboard. They were the biggest QE policy in the world quickly. And meanwhile, the Treasury's been running surpluses. And you go, why are you running surpluses for? Why haven't you been attacking inflation ex-COVID? So they're all culpable, and they're all ducking and weaving, and none of them are being honest.
John, I think we've probably run out of time, but some wise words there. It's time to ignore the noise and look through the daily volatility, stay invested according to your personal investment objectives, and keep a calm head. And the prospects a bit further out still look pretty good.
What are they saying in Paris? What are they saying in Paris? Aussie. Still the best place, the strongest growth in the world, just run by idiots.
Yeah. Okay. Well, thank you very much. And we will wrap up there. Thanks, John.
Yeah.